Hello and welcome to another video on Ind As from GJ Management Consultants. So today we are here to present on Ind As 23, which is borrowing costs. The topics that we are going to cover today are objective in this scope. What is borrowing cost? What is the definition of qualifying asset? Under what circumstances we have to capitalize the borrowing cost? When to suspend and stop the capitalization? Definition of specific borrowing, what is general borrowing, and then exchange differences as the borrowing cost on the inventory disclosures, and finally we quickly have a comparative analysis from IAS 23. So we'll start the discussion. We'll move to the first slide. Okay, so we'll quickly talk about the scope and the objective of Ind AS 23. So objective of Ind AS 23 is to prescribe the accounting treatment for the borrowing cost, specifically when borrowing cost should be capitalized and when borrowing cost to be expensed. So typically, we are here to answer two questions or two fundamental areas in which borrowing cost have the most impact. One is when to capitalize the borrowing cost and when to expense it off. So which means that the core principle, what does this say is that borrowing costs that are directly attributable to the acquisition, construction, or production of a qualifying asset forms the part of the cost of the asset. So we'll also look at the definition of the qualifying asset, because to capitalize the borrowing cost it has to be first established that the asset that is going to get constructed is the qualifying asset. If it is the qualifying asset, then definitely the borrowing cost will be capitalized, and that also needs to be done at a particular stage, and post which the capitalization the cost would be expensed off rather than being capitalized. And what is the scope? What does Ind AS 73 applies to? So interest expense, amortization of the discount and premium, finance charges or the lease liability, and exchange differences regarding the interest cost. So we'll talk about this in detail in the upcoming slide. What is excluded? Equity instrument, trade payables without interest, asset measured at fair value, example biological asset, inventories that are manufactured otherwise produced in the large quantity or repeat. So basically we know that anything which is produced and which is not a qualifying asset with the borrowing cost will not be capitalized. And likewise, when we're talking about inventory, there are inventories. Normally, inventories is treated as something which is being getting produced and within a span of less than 1 year, and hence it does not require and fall in the definition of the qualifying asset. There are certain exceptions to it. We'll talk about those exceptions in the upcoming slides. And when we try to compare it with equivalent standard with IAS 23, it is same. There is no difference between the scope and the objective of the IAS 23 with respect to Ind AS 23. So we'll move to the next slide then. Okay, we'll quickly touch base upon the definition of the borrowing cost. So what is borrowing cost? So borrowing costs include all the costs that has been incurred in the payment of the interest that we have taken in form of a loan or the overdraft. It will also include any ancillary charges that has been paid and that is normally amortized over the life of the loan or the life of the debt borrowing that we have done. And then it also includes the implicit charges on the finance charges on the leases, which is being governed by the Ind AS 116. It also includes the exchange difference to the extent regarded as the interest cost. And if we'll take quickly an example, the company has taken a loan on which interest cost is 1 lakh, processing fees that has been amortized is 10,000, the borrowing cost is 1 lakh 10,000. We'll try to compare it with the IAS 23, both the definitions are aligned. So we'll move to the next slide. Okay. So we talked about the qualifying asset and the capitalization of the borrowing costs. We'll quickly have a look at the definition of the qualifying asset. So qualifying asset, when we talk about, is an asset that necessarily takes a substantial period of time to get the ready to use or sale. And some of the examples of qualifying asset are power plant under constructions, large manufacturing plant, investment property under construction. What are not qualifying are the non-qualifying assets, or are the inventory produced quickly, ready to use machinery and financial assets. However, when we were having this presentation on Ind AS2, which is like on the inventory, we came across a few of the inventory which takes normally more than a normal period of time to produce, specifically the real estate inventory and specific to the wine industry. So which takes normally more than the normal period of time to produce. In which case the borrowing cost would be added to the cost of my inventory. So, and this concept is largely aligned with the in IAS 23. So we'll move to the next slide then. Okay. So we'll quickly talk about what are the conditions under which borrowing cost will be capitalized. So borrowing cost will be capitalized when three conditions are met, and all these conditions needs to be met. Expenditure on the asset is incurred, borrowing cost has been incurred, and activity necessary to prepare the asset are in progress. So which means that we have taken the loan, we have used that loan to produce an asset, and that activity of production is still going on, and then we are paying the interest on that. So if these three conditions are being satisfied, then only we could able to capitalize the borrowing cost. So to the extent that entity borrows the fund specifically for purpose of obtaining a qualifying asset, entity shall determine the amount of borrowing cost eligible for capitalization as the actual borrowing cost incurred on that borrowing during that period, less any investment income or temporary investment for these borrowings. So which means that it may so happen that we have taken a loan, and we for that particular amount of loan, we are not going to expend all amount of that that we have procured as a loan in one go. So which means that we can still have some time to utilize the entire loan. So what normally company do is the companies use that amount and invest that amount in a temporary funding, temporary FD or temporary mutual fund or temporary liquid funds, which yield them some interest income. So in which case the interest income that has been earned, that will be netted off against the borrowing cost that is being incurred for that particular loan. And an entity shall capitalize the borrowing costs that are directly attributable to the acquisition, construction, or production of qualifying asset, part of asset. An entity shall recognize other borrowing cost expense. So which means that if we have procured a loan and we are specifically using that loan for that particular asset, then only the cost that is attributable for production of that particular asset is going to get capitalized. If we are using that funds for some other purpose, for general purpose, then it will not be going to get capitalized. It will be expensed. And this definition is absolutely aligned with the IAS 23. So we'll move to the next slide. Okay. So we spoke in the last slide that when we have to capitalize the borrowing cost. Now we'll talk about the situation when we have to suspend that capitalization. So what does it says that? It says that an entity shall suspend the capitalization for borrowing costs during the extended period in which it suspend active development of qualifying assets. So we know that a qualifying asset is an asset which requires a substantial amount of time to produce. In that period, it may so happen that for temporary period that production is getting halted, and that is because of a reason which is beyond the control of the management. So in which case that for that particular period, whatever borrowing costs that we are incurring, that should not be capitalized, and that there would be temporary suspension of that particular borrowing cost. So what it says that an entity may incur the borrowing cost during extended period in which it suspends the activity necessary to prepare an asset for intended use. Such cost of the holding partially completed assets are not qualifying for the capitalization. However, an entity does not normally suspend capitalization borrowing costs due to a period when it carries out substantial technical and administrative work. So which means that if there is some substantial technical and administrative work is required, which is a prerequisite to produce an asset, then it will not be suspended capitalization. Or if an entity does not also an entity does not suspend the capitalization borrowing cost when temporary delay is necessary part of the process for getting the asset ready for intended use. So which means that if temporary suspension on any kind of technical or administrative work is required, which are the prerequisite for produce an asset, and if there is some delay because of that, then in that case the interest cost will still be capitalized. But if the delay is beyond a particular reason, then it has to be expensed off and it will not be capitalized. A typical example is given here: when construction of an asset is stopped for 6 months due to labor strike, interest during this period is will not be capitalized, it will be expensed off. And same treatment is being mentioned in the IAS 23. So we'll move to the next slide then. Okay, so in the last slide, we spoke about the suspension of the borrowing cost. In this slide, we'll speak about when the borrowing cost will cease to be capitalized. So an entity shall cease capitalizing the borrowing cost when substantially all the activities necessary to prepare the qualifying asset for intended use or sale has been completed. Which means that everything has been complete. Asset is put to is intended to asset which was intended to put to use has been put to use, or asset which was intended to be sold is in the condition in which it can be sold. So an asset is normally ready for intended use or sale when the physical construction of asset is complete, even though routine administrative work might still continue. If minor modifications such as the decoration of the property or the purchaser or the user specification are all said to be outstanding, this indicates substantially all the activities are complete. When an entity completes the construction of the qualifying asset in parts, each part is capable of being used while construction continues in the other part. The entity shall cease capitalizing borrowing costs when it completes substantially all the activities necessary to prepare that part of the intended use asset. Which means that if multiple components are getting produced, then each multiple component will be treated as a particular asset depending upon whether that component is being capitalized separately. But if let's say all those components needs to be clubbed together before it can then be produced as a final asset, then till all the components are not produced, it will not be treated as the final production of the asset. So the thumb rule is that if the production is complete, then we have to stop capitalizing the borrowing cost. Then from that day onwards, all the borrowing costs will be expensed off. But before that, it will be capitalized, and then post that, if there are some minor activity which is largely to the beautification of the asset, then those will be expensed off, because the asset is now ready to be and ready to use, or it is now available for the sale. When we compare this definition with the IAS 23, they are largely the same and there is no deviation. So we'll move to the next slide then. Okay. So specific borrowing. So what is specific borrowing? So if we have borrowed a loan for a specific asset, we have taken a loan for that particular asset, then that is that is normally called as specific borrowing. Borrowings are taken specifically for acquiring, constructing, or producing a qualifying asset. So what we have to do, we have to capitalize the actual borrowing cost, net of temporary investment income, as we have talked about this in the previous slide. So small example here: loan taken 10 crore and at the rate of 10%, interest is 1 crore. Temporary FD is 10 lakh. So capitalized borrowing cost with the 90 lakhs, which is like net borrowing cost, which is like net of the interest earned. So, and this definition is fully aligned with IAS 23. So we'll move to the next slide. Okay. So in case of general borrowing, the concept is that we have to calculate the weighted average rate. So apply the capitalization rate, weighted average on the borrowing cost, which is like general loan of 5 crore has been taken at the rate of 8%, and then another we have 5 crore at the rate of 10%. Weighted average is 9%. So if let's say we have done asset on the expenditure of let's say 4 crore, then the capitalized interest would be 9% of 4 crore, which is like 36 lakhs. So this would be capitalized, and it will not be like we have to do the separate capitalization for each of those loans. So a weighted average will be taken, and that average rate will be applied on the interest that has been incurred on the borrowing, and we'll capitalize that interest. This is that qualifying asset, and this is aligned with the IAS 23. So we'll move to the next slide then. Okay, so now we are going to talk about a situation under what circumstances my exchange differences would be added to the borrowing cost and subsequently got capitalized. And what is when is that going to happen? That can only happen to the extent they represent an adjustment to the interest cost. And what is this adjustment? We'll talk about this through an example. So we are taking an example. We have a qualifying asset. The construction period is 1 year. Foreign currency loan is 1 million USD. Exchange rate when we avail the loan was 70 per USD, and exchange rate at the end of the year is 75 per USD. Interest on the loan is 4% per annum, and comparable INR loan interest is 10%. So we clearly see that there is exchange difference, and because of that, the exchange difference, there is amount of the liability which is going to get inflated by rupees 5. And what is that inflated amount is 5 multiplied by 1 million, which is equal to 50 lakh. So there is an increase in the liability of 50 lakh. Now, this increase in the liability, which will lead to debit my PPE and credit my liability. But this is not the case, because we have to compare this increase in the liability with the adjustment in the interest cost. And the amount which is attributable to that adjustment will only be capitalized, rest would be expensed off. What we have to do, we have to look at the interest rate at the which is being available at which we have taken the foreign currency loan. So that is the 4%, and my outstanding interest, if we are taking the rate of 75 at the end of the year on 7 crore 50 lakh, is 30 lakh rupees, right? But when we try to compare it with the 10%, so now this is 10% is applicable on 7 crore, because I took the loan at the rate of 70, and this is the notional interest. So our interest adjustment is basis that is 70 lakh. So my interest adjustment is 70 minus 30, so which means that my 40 lakh is the interest adjustment. So my PPE would be capitalized to the extent of 40 lakhs, and rest, which is like 50 minus 40, would be expensed off. So if this would not have been a foreign currency loan, then in that case, it is normal loan, then there is no question of the translation of the foreign exchange is there. But because this is a foreign currency loan, and hence any increase in the liability which is on account of the rate exchange will be capitalized only to the extent of the interest adjustment. So as we have shown that it is the interest cost adjustment is the only applicable amount which would be added to my PPE, rest would be expense off. So what we are saying here is that 10 lakh, which is like excess exchange difference, that would be expensed off, and 40 lakh, which is the difference between the difference between the interest element of the loan which is being obtained from the US versus the similar loan, if it had been available in Indian scenario, that difference is 40 lakh. This is something which will be added to the cost of my asset and capitalized, and rest 10 lakh would be expense of. So this is the most critical aspect of this borrowing cost in DAS. And this definition and this logic is entirely aligned with the IAS 23. So we'll move to the next slide then. Okay. So we also spoke about under what circumstances my borrowing cost is added to the cost of the inventory. So we'll quickly have a look at that. Inventory is not a qualifying asset. Exception is the inventory requiring substantial time is wine, ships, large real estate inventory. So in which case we can add that amount in the cost of the inventory. Interest cost to be expensed off or to be capitalized for the above exception. So which means that otherwise every interest would be expensed off, but in these cases it would be added to the cost of my inventory, and this is in line with the Ind AS 23, IAS 23. So we'll move to the next slide. Okay, so we'll quickly cover two more points here, disclosure and the comparison. So when we talk about the disclosure here, so entities must disclose the amount of the borrowing cost capitalized and the capitalized rate used. And if we do a quick comparison in terms of IAS 23 versus Ind AS 23, so everything is aligned. There is no gap to it. Minor differences here and there, largely on account of the Schedule 3 for the reporting purposes. So this is largely the last slide wherein we have covered the disclosure and comparison, and we'll move to the final closing slide, which is the thank you slide. Okay, so we have come to the end of this session. As usual, this is my sincere request to all my viewers and subscriber to please watch this video till the end, and then please cascade to all the relevant people to whom you feel that this video would have some relevance, and keep watching our Ind AS video. We are going to come up with next Ind AS very soon. Till then, thank you, goodbye, and have a nice day.